Hey, good morning, guys. Welcome to Market Mondays. Hopefully, you guys had a great weekend. I just got back from San Diego last night, so I'm pretty hot up on the sunshine. But we're gonna be talking about the failure of SVP because it just popped up last Friday. What's happened mortgage rates since then, and what's expected to happen throughout the rest of the economy through the rest of the week, or really for the rest of the month. So before I get right into it, do a quick dad joke for you guys. So, did you hear about the soldier who survived both mustard gas and pepper spray? Mustard gas and pepper spray. He was a very seasoned veteran. All right, so getting right into it. So SVP has been a huge topic over the last couple of days because of the failure of the entire bank. It's a huge bank in regards to like lending to a lot of tech startups, and a lot of tech startups use that bank to kind of bring up their company, right? So SVP basically closed its doors and was completely shut down on Friday. And why was that? Well, it wasn't so much everything that the Fed did, it was more of like user error. If they were paying attention to the economy and how the economy was going, how to properly read the certain reports that come out, they may have been able to mitigate or even survive through the issues the economy is going through. So basically what happened was that SVP had a bunch of hidden losses over the last 2 years. Basically, any company that's alive today has a bunch of losses because of how the Fed rate has changed. Now, the other thing to note is that they haven't had a risk manager, a risk portfolio manager for the last 8 months. And in the last 8 months, things have changed a lot. Some of the assets they had were really low rate of return bonds. Well, and they've held those since 2020. They hadn't sold and bought new bonds to kind of make up for the losses. So they were holding on to these 2% coupons of bonds, which don't really exist since 2020, maybe 2021. And they haven't sold them to buy the higher yield bonds to make up the losses. So they didn't change their financial strategy. They just kind of held on to something that doesn't exist anymore. Well, the crazy thing is that resulted to about 15 billion of unrealized losses. And once that's been realized, a lot of depositors started taking their money out of the bank. Well, as they start taking money out of the bank starts to lose its cash asset, their value of the house, or sorry, value of what they have in their bank for the depositors to withdraw money. Well, the other side of it is, whenever the bank loses money like that, they usually get a loan against the Federal Reserves to continue to let depositors take money out. Well, unfortunately, because the stock fell so sharply, they couldn't take out another loan. They couldn't take out another loan from the Fed. So luckily, the Fed was able to, cover the losses, cover all the depositors, things like that, so that everyone gets the money back. But effectively, that bank is gone. SVP is a bank that doesn't really exist anymore. So a lot of it was user error because they weren't paying attention to the economy. They weren't paying attention to, selling their losses at the current time and buying new ones to match the current economic climate that we're in. It's a lot like buying a stock at a high value and then selling it at low value, or keeping it as the company starts to go toward bankruptcy. So that's what they didn't do. What you should do is just realize your losses now. It's not about making money at that point. It's about reducing your losses. So if they had pivoted with the economy like they were supposed to, but then they may have been able to survive through this entire thing that we're going through. Now, with mortgage rates, what have happened? On Friday, that's when we saw the big loss. We also got the jobs report, which was a really great impact on mortgage rates, I should say. Unemployment rate did go up, and mortgage rates actually improved that day, which was great because we started seeing below 7 again. That was the average rate. Now we're here on Monday. There's been another big improvement as well, and then we're expecting another big improvement tomorrow because of the inflation report that's coming out tomorrow. And that's the first inflation report for the month of March. So we're excited about that. Maybe we see a nice big bump again. Or effectively, as of Friday, we were better off. We were back where we were in mid-February. As of today, we're probably about where we were at the beginning, I would say, of February, I would say. So I'm looking at it. We are about, we're about just a little bit, we're about where we were at the beginning of February, which is about, the mid to high sixes. So everything's are looking great as far as for the setup tomorrow. So hold your horses. We're expecting rates to get a lot better tomorrow as well. Anyway, that's all I got for you guys. Nuke out.